Talk stock news, though. Link administration pegging a $55 million hit to its revenue under the proposed changes to superannuation, with the new law stopping the pilfering of inactive accounts set to come into effect the 1st of July next year. The market responding well to the update. However, shares up by the biggest amount in over 2 years. The company saying the impact from any reduction in the number of member accounts is actually not anticipated till around about 2020. Well, Chris Conway from the Australian Stock Report joins us now. To start, let's kick off with Link. Yes, it's up, well, it's about 5.5%. We need to put in context, don't we, Chris? It got sold down to the tune of about 20% off the back of the budget announcement around superannuation.
Good afternoon, James. Yes, you're entirely right. It was a 4-day slide to the tune of, as you say, 20%. And it was really around the uncertainty of what the budget measures would mean for the bottom line. I don't think Link did themselves any favours by coming out with an announcement and not addressing some of the metrics around that. They have done that today. As you rightly said in the lead-in, it's a $55 million hit if the budget measures were to be implemented basically this year. And that's not taking into account any of the mitigating factors that Link and the companies that they serve, so the superannuation funds that they serve, doing anything to intervene in that process. Again, as you rightly state, it relates to a cap of 3% on fees for accounts below 6,000 and any inactive accounts. So that's, I think it's 13 months or longer with no activity and a balance of less than 6,000, they go back to the government. So look, Link would lose clients obviously under that proposed setup, but a $55 million hit on a company that has revenues of $1.2 billion. Not surprising to see the market react positively today to the news.
And do you think that continues, Chris? I mean, people now looking at Link, is there, do you think, a potential opportunity in Link at the moment at these levels?
Yes, certainly that's the way we're viewing it, James. Look, we, to be transparent, held it prior to obviously the sell-off, but we continue to like it. You know, obviously this is a situation where there will be an impact. Link has clearly said that today. But just looking past that, you know, the company recently raised about $300 million. They're paying down debt. They do have the capacity for further bolt-on acquisitions, and they're still, you know, reaping the benefits of synergies from the acquisition last year out of the UK.
Let's move to another stock if we can. Essentially a downgrade earlier this morning from AHG, Automotive Holdings, down to $75 million. I was looking at it before coming when the market opened. I think consensus was around $85 million. Challenging trading conditions impacting margins, never a good story.
No, not a great story at all, James. And look, it's, you know, sort of a West Coast story. I have some mates that work in the car industry, and anecdotally they say on the East Coast, you know, Sydney and Victoria, sales are really strong and doing quite well. It's really a West Coast story. The market just hasn't recovered as analysts and even the company itself were anticipating. You know, it's a 12% markdown, 85, 84, as you say, into 75, 12% hit. Not surprising to see the stock off 10% today.
Yeah, getting crunched, as you say, 10% holding, just above $3 at the moment. Look, the big one I want to spend a bit of time with you on is Telstra. The stock's down 3.5%, $2.94 at the moment. Speaking to an analyst from Watermark earlier this morning, he's suggesting, you know, BT is the case to look at over in the UK when trying to figure out where value emerges for Telstra. He suggests down around about $2.14. I mean, sentiment's so negative on this stock at the moment. It's quite extraordinary. And look, off the back of that update, which is very, very soft, it's hard to blame the market being so down on it.
I totally agree, James. Couldn't argue with that. It wasn't so long ago that we at Australian Stock Report were looking at potentially a big revenue hole for Telstra, in the sense that the company had benefited quite a lot from some network problems at its competitors. Yeah, so we all know about the network problems at Vodafone. You know, Vodafone and even Optus have invested heaps of capex recently, and that benefit that they were enjoying has eroded, and it's come back to more the long-term average of typical market share between these players. The other element to all of this is, you know, Telstra used to be able to command a premium because they had better coverage. Now in population centres, that's no longer the case, and you've got increased competition. So it's really a double-edged sword. You know, the benefit that they were getting because of network issues has gone away, and now they're facing cost pressures as well. So, you know, that's a massive hole in their mobile division. I think it was, you know, sort of circa $600 or $700 million, and it's coming to fruition. Throw on top of that the problems with the NBN, and, you know, it's not a wonder why the company has been sold off so aggressively lately. I can't see a reason to buy this stock at the moment. Everyone talks about the dividend yield. Macquarie analysts were out today saying that they see that as being slashed down from 22 cents per annum down to 20 cents for the next 3 years, and then potentially lower after that as well. So, look, we haven't done anything around the dividend, but obviously there's plenty of people out there in the marketplace that think it's going to head lower. So there's not even the dividend support there for the meantime. So 2.14, who knows? It could happen.
You struggle to see how things are going to get any better for Telstra as well, unless they drastically change, their strategy, because a lot's being made of TPG entering the market, the mobile offerings that they're going to be introducing, 6 months free, followed by capped out unlimited plan at under $10. I mean, I was looking at the ARPU for mobile for Telstra. Yes, it's down, but it's still around $65.35, which is still extraordinarily high ARPU when you look at global peers. That's going to be eroded further, surely.
It has to, James. I'm really surprised that Telstra hasn't done more in this area, because I reckon it's 2 or 3 years now that all of us have been talking about just how intense the competition is in this space. There's a finite number of consumers here in Australia. They're charging $65 for a bundle. Competitors are charging sort of $30, $45 probably for a comparative bundle. And again, like I said, that element of Telstra always having the best network coverage, well, it's only in certain areas of Australia now, and regional areas where the big dollars aren't anyway, just in terms of population numbers. So, yeah, I totally agree with you, James. It's a struggle to see where they're going to make up this revenue, and in actual fact, it's probably likely to get much worse before it gets better. Yeah,
I couldn't agree more. Look, in terms of the telco space, is it, from your perspective, a similar story? I mean, people talk about TPG. It's being sold down again today. I mean, are there opportunities outside of Telstra, or is the broader telco space one that you're just staying away from?
No, given the performance of the telco space last year, James, it was by far the worst performing sector. It's not a space I like to play in, certainly at least from the buy side. I'm a trader, however, so I look at the share price of Telstra or the chart of Telstra and see it's been in a downtrend for an extended period. We know all the worries around it. We know the sentiment is terrible. I'm shorting it. So I can play in that space, but not on the buy side, James.
Can we talk Boral, which I believe is one that you own? What have you made? It's been an interesting stock to watch the last month or so, really off the back of the update and some of the weakness out of the US. I mean, it was weather related, which suggests they'll make that back, but it seemed to flare up concerns around the Headwaters acquisition. What gives you confidence in Boral moving forward that some in the market don't see?
So there's a couple of reasons. As you say, the factors that caused the downgrade, and yes, it was weather related, so you have to discount that a little bit. What I would say is a worry, and this is coming from a holder of the stock, is it's the second time the Headwaters acquisition has had issues. So the second time they've had to come to market and say, we're sorry, and put their hand up. They are transitory factors. With such a huge acquisition, you've got to continue to expect that there might be some teething problems. But then you look on the other side of the equation, Headwaters and the US operation still only accounts for 25% of Boral's revenue, the other 75% still here in Australia. So they've still got a very solid base, benefiting from infrastructure spend here in Australia. And we know about potential infrastructure spend in the US. That essentially has to happen. Bridges, buildings, highways, are falling apart over in the US, and it's been happening for a long period. You look at the New York subway, you only need to ride that to know that needs a multi-billion-dollar upgrade. So there's plenty of scope there for Boral to be performing well in the US. So transitory factors, I'm happy to look past them, but they wouldn't want to get a third one, James. Let me tell you that they wouldn't want to get a third knock.
Can we just, Chris, finally talk about the broader markets? Had a good run earlier. I think in the opening moments we hit a fresh decade high. I think we got as high as 61.40. We've retreated since then. Your thoughts on how the market's trading at the moment, and certainly some of the levels that seem to be in the mind of many traders?
Yeah, so certainly, James, look, 61.50 is sort of where it's all at. That's the January high. It's not surprising to see us, I think, struggle here. We don't necessarily need to peel lower, but I wouldn't be surprised to see us grind sideways for a period. And it's really about the pace at which we've arrived where we have. So, it's a 6% rally since the April low. And it's, you know, even if we have a losing session today, it's 17 out of 22 sessions that have been winners. So you just look at it and think we can't sustain this pace. We're at a huge level. And the other thing is, what is the catalyst that gets us over this hump? That's really the thing that I'm thinking, other than the technical resistance. What's the thing that we can all point to and go, aha, we should be paying 61.55, 61.60 and all the rest for this market? So we need a catalyst, and failing it, I think we grind sideways for a while.
But remain relatively happy to be long the market?
Yeah, I'm net long across the positions we hold for clients. Yeah, like I said, I don't think we need to have a drastic pullback. I don't think we need to go back to 6,000 and go again. I think we can sort of hover around current levels, and if we get a positive catalyst, then, you know, away we go. And once it does break, the other thing that's likely to happen is it could move very, very quickly.
All right, Chris, great to talk as always. Thank you.
Thank you, James.
Chris Conway there. Let's move on, get you across some of the other stories.